Hi, everyone, and welcome to another fresh new episode of our Made for YouTube series. I'm Sumaira Abidi. And today we want to discuss two particular categories of debt mutual funds. One is the corporate bond fund, and the second is the banking and PSU debt fund. Now, both these categories have been pretty popular in the past, and they were seen as very, very attractive at one point. But for a few months now, we're seeing money go out of these funds. So, what exactly is the reason that investors have switched to fixed income at Axis AMC to try and give us some answers? Devang, thanks very much for joining in. So, my first question is just this: what is it that's bothering investors here?
So I think, obviously last 12, 18 months now, since the time the pandemic started, we actually witnessed lots of inflows in these categories. So I would say corporate debt, banking PSUs, and short-term categories has been the flavor of the season. And as an industry, we probably received more than 1 to 1.5 trillion of flows in these categories all put together. Actually, the market reaction also, as well as at that point of time, all the steps which RBI took, both from a perspective of monetary policy easing on rates, as well as massive injection of liquidity, augured well significantly for all these categories. The capital gains as well as rally in yields continued till December. Post that, I think since January, the 2 year, 3 year, 5 year corporate bonds probably have traded in a range. We have seen some bout of, I would say, uneasiness on RBI, where RBI started with the variable reverse repo in January 2021, which came as a bit of a surprise. Then a couple of steps of, I would say, additional VRRs being announced by RBI, and some kind of hawkish commentary because of inflation prints being all over the place led to this confusion in the market participants for the last 6 to 9 months. I would still like to correct that we have not seen any massive outflows in these categories. I think the inflows probably have slowed down a bit, or they have been marginally less in this financial year and calendar year as compared to what we had seen last year. Also, absolute levels, thanks to all this liquidity as well as rate cut measures, the 2 to 5 year corporate bond space has seen massive rally in bond yields in the last 12 to 18 months, where they were probably 675, 7% band pre-pandemic. The uncertainty and the shock in the start of March 2020 led to the yields blowing for corporate bond in the 8% handle. From 8%, they have all gone down to the 2 year corporate bonds now are trading at 4 quarter, 4 half, 3 year corporate bonds at 5%, and 5 year corporate bonds probably in the band of around 560, 570 band. So we have seen a massive rally of more than 200 to 125, 150 odd basis through 200 basis of rally in corporate bonds in the last 12, 18 months. Absolute levels are low. We are at the cusp of the reversal cycle now. I'm sure we all read the monetary policy minutes, and yes, there is a set of MPC members who start believing that liquidity should start normalizing. Also, there are a set of MPC members who start believing that the reverse repo should go towards the 4% mark. So, with this context, where most of the rally is behind the curve, the corporate bonds had significantly outperformed in the last 12 to 18 months, absolute level being significantly lower now. The incremental flows have remained muted in this year. uh, I personally don't see any significant challenges, but yes, what had been the flavor last 12, 18 months, I think incrementally at the bottom of the cycle, it makes more sense to stay in the lower duration categories at this point of time.
Okay, understood. No, I don't mean, flows are negative for the year. I meant incrementally, month after month, you're seeing money going out. Devang, to some extent, a lot of us retail investors, we understand, how treasuries work or how uh, the government bond market works. The corporate bond market is still a mystery to many of us. For investors who are investing in funds that have corporate bonds, what are the few things that we should keep on our radar? I mean, what is a simple way to understand the corporate bond market in India?
Sure. So I think, see, corporate bond markets, if you look at most of the categories of mutual funds, and we have probably a lot of short to medium term categories, which is short term category, banking, PSU, corporate debt, as well as medium term. There are three to four categories which have a significantly higher exposure in corporate bonds put together. The total AUM in this category would be upwards of 5 lakh crores as of today. Our understanding is, if you see on a simplicity purpose, I think what markets need to look across at two to three parameters. One is the absolute quality of the corporates which the mutual funds are investing into. So AAA oriented, if I look across at most of the schemes in these categories, and I'm talking about 4 to 4.5 lakh crores of categories, is massively invested into AAAs. So I would say 80 to 85% of these schemes are all investing in public financial institutions, PSUs, bank bonds. So when I look across at the overall rating category of these schemes, it is highly invested into very, very high quality AAA oriented assets. The second thing which we need to look across at from an investor perspective is the duration of the fund, because I think being a quality bias, the only characteristics which can lead to volatility in returns and a return expectation for investors is the duration bit. Today, if I look at again the category wise, be it short term banking PSU or corporate debt, most of these categories are running an average duration of sub 2 years. So if you ask me from an investment perspective, these are very, very good substitutes against traditional FD investments or traditional corporate FD investments. I think mutual funds investments into short term banking PSU and corporate debts are good substitutes for those traditional investors.
Okay, Devan, I take your point that they still make sense. Um, can you explain a little bit about both categories? Like, suppose, let's say, if we start with the corporate bond fund, what exactly is the objective that it fulfills in a person's portfolio? Like you said, most of it is AAA, but yet there is no, parameter in terms of credit quality that SEBI has laid out, right? So therefore, how does a person understand the category, what to look for, and where does it fit in a person's portfolio?
Sure. You see, corporate debt category, if you look across at the SEBI mandates us to keep more than 80% at all point of time in corporate bonds, and which are AA plus and above rated. So if you look across from a regulatory perspective, also corporate bond categories are funds and
Okay.
category which are
I,
significantly quality biased.
yeah, I correct myself. There is a requirement, right?
Sure. So, see, from a regulatory as well as an overall requirement perspective, I think corporate bonds category of schemes are quality buyers, and they are a traditional substitute for investors who are looking at traditional investments like FDs, FMPs. So, these are good investment options available to traditional conservative investors. From a perspective on how generally the funds invest, I think biasness is towards corporate bonds. Again, the view generally is towards the interest rate cycle. Most of the corporate bond categories generally try to capture the 2 to 5 year corporate bond segment. I've witnessed it time and again over the last 15 years or so. Generally, the short term corporate bond banking PSU categories invest in 2 to 5 year corporate bonds, and these are, I would say, the view is I would more a combination of liquidity in the banking system as well as an interest rate cycle. Again, today being an environment where we are at the bottom of the interest rate cycle, I think most of the industry players have realigned their durations to be at the lower end of the curve. And as I explained you, most of them are running sub 2 years duration.
Yeah.
Even if we see an upward interest rate cycle or some kind of interest rate volatility, because the absolute duration is so less over a period of the next 2 to 3 years, we don't see any kind of significant risk on interest rate parameters to these funds. Yes, the capital gains and the huge returns which these categories has delivered over the last 2 years or so is behind us. But incrementally, from a safety and a conservative option, these funds continue to remain a good investment solution for retail investors.
Right. What about this banking and PSU debt fund? Is this the debt equivalent of a thematic fund?
So I would say so. There are certain funds which people try to live across specific sectors. So here, what generally a banking and PSU is a kind of a fund where 80% of your instruments or the portfolio is invested into banking instruments or public financial institutions and public sector undertakings. Again, if you look across at most of these PSU, PFIs, and banks in India are all AAA rated, quality biased. The general tenor of instruments issued by these banks and public financial institutions, including public sector undertakings, are in the band of 2 to 5 years. So it is just a specific, I would say, allocation where traditional investors are looking for safety options. Now, in India, what is considered safety is one is the government bonds, and then secondly, quasi-government substitutes and public financial institutions, public sector undertakings, which are all owned 100% or majoritarily by government, are considered to be significantly from a safety perspective. So I think these funds are launched from a perspective of two ideas: one, conservative, quality biased, and secondly, having a category which targets to the I would say the short-term corporate bond space in India.
Okay, understood. So, if the call is that it is still okay to make fresh investments here, and like you said, that perhaps conservative investors may find comfort in investing here. Let me just ask again, what exactly are the kind of investors who can, benefit from having corporate bond funds or banking and PSU debt fund in their portfolios?
Sure. So I would say two, three perspectives. One is what we are advising clients is one is we are, as I explained you, we are now reaching the bottom of the interest rate cycle. I'm
Yes.
sure if you look at the commentary from the RBI also, the members there is a divided opinion, but currently at least the MPC members from RBI are continue to remain very dovish. Our view is that if we don't see any kind of significant impact of third wave, and if you ask me, somewhere down the line, the fears which markets were looking at or thinking across couple of months back are actually fading away. So if there is not a significant third wave, the growth cycle should start looking good post the festive season. Somewhere down the line, we should see RBI realigning and start withdrawing the significant accommodation which they had introduced in the last 12, 18 months in a very slow and gradual pace. Corporate bonds, short term, and banking PSU categories, all the three categories, I would say, are interchangeable from an investor perspective. When I look across at which category of investors should or what should be the time horizon, it is generally for people who are traditional investors who look at I would say very conservative portfolios, AAA oriented strategies. It is generally suited for those category of investors. The investment horizon, because we are at the bottom of the interest rate cycle, should be medium term. It should not be short term. Last 12, 18 months, as I told you, the capital gains in this category have been upfronted. Today, the YTMs or the yields of these products are sub 5 or broadly around 5%. So, one, the return expectation should be conservative. Secondly, the investment horizon should be medium term, and these are well suited products for traditional investors.
Got it. Devang, thanks so much for sparing the time and explaining these two categories to our investors. So, guys, I hope this was a learning experience for you. If you have any further comments and questions, we'll try to bug Devang and get those answered as well. But I hope you enjoyed it. And if you have any suggestions for topics you'd like us to cover in the future, do send those in too. We look forward to hearing all of your comments. All right, so with that, we're going to wrap up. Stay safe and thanks for watching.